The central bank yesterday announced its third round of quantitative easing since 2008. I'm joined down the line today by David Semmens, senior US economist at Standard Chartered, to discuss what this latest news will mean for the US economy. Mr. Semmens, thank you for joining me. Ben Bernanke said that he is trying to get the economy moving in the right direction, but the central bank didn't set any limit on the ultimate amount it would buy or the duration of the programme. Was this expected?
Well, from our perspective, we were actually looking for them to take no action, although this was a non-consensus view, but what we were expecting if they were to take action would be a large programme which would be open-ended and tied to some economic criteria. Now, what the current programme leaves is a rather large uncertainty about what is the criteria for them to end the programme. And they're looking for substantial improvement in the labour market, which obviously is relatively ambiguous, but given the likelihood that we're going to see comparatively slow progress in the labour market going forward, it leads people to believe that from the Fed's forecasts, we can expect them to be on hold out until continue to perform quantitative easing out until the latter half of next year at the earliest.
Unemployment was a theme in yesterday's announcement. Bernanke said stimulus will be expanded until the Fed sees sustained improvement in the labour market. How will QE3 affect unemployment in the US?
Well, we'd look for there to be a knock-on effect from the mortgage purchases in lowering mortgage rates, and this will allow people to refinance, which will mean that they're paying less in terms of their mortgage payments, which will mean that consumers have more money in their pocket. It's also going to create more demand for risky assets as yields will become lower on mortgage securities, and that will push people further out the curve. As you've seen from the reaction today, it's been encouraging for risky assets, and that also is going to have a portfolio effect, which will see people feeling wealthier, and that will in turn improve sentiment.
The Fed extended its commitment to keep interest rates near zero, saying they wouldn't move higher until 2015. Do you see interest rates remaining stable in the US?
Well, at the moment we don't see any inflationary concerns, and we think the Fed can afford to stay on hold until you start seeing inflation drift upwards and becoming a threat. What the statement showed yesterday was that their reaction function to economic variables is entirely in focus now on getting unemployment down. So we think given that inflation is around their target level, they're going to be pretty tolerant unless you see inflation move towards 2.5%, 3%, and that's core inflation, which takes out the volatility in food and energy. So from our perspective, we do think they're going to be remaining on hold until the third quarter of 2015. Unless you get a spike up in inflation, and that has to be a sustained spike up in inflation as well. A temporary spike is not going to be of concern to them while you've got unemployment above the 7% mark.
Growth outlook has also been upgraded from 2.8% to 3%. Why has this outlook changed, and is this likely to happen with the economy in its current state?
Well, when you look at the growth outlook being upgraded, that's actually not for this year. They downgraded their growth outlook for 2012. They lifted 2013 and 2014. Now, this has been lifted because they believe that the actions they're taking now are going to work, which has got to be encouraging for the market. But you would expect them to do this. Otherwise, people would be concerned that they feel there's not going to be an improvement from the actions they're taking. So they are, from our perspective, saying these are the actions that we're taking, we think they're going to work, and so we think the outlook is looking better. Now, we have a slightly less upbeat outlook for 2013. We're only looking for around 2%, but for 2014 we're looking for the outlook to be stronger in the US, to gather momentum, and we would expect this program at the margins to be a positive for growth, but we need to see what happens with regards to the fiscal cliff at the end of this year to really have a much better picture of what 2013 is actually going to look like.
Lastly, how will the latest round of QE affect the US economy for the rest of 2012?
Well, in the short term, we're looking for the second half of the year to be relatively stable. We're looking for it to get around 2% in both Q3 and Q4, and we're not looking for there to be a substantial pickup on the back of this. It will take time to feed into the real economy, although it's fed into the financial markets very quickly. The transmission mechanisms are completely different between the real economy and financial markets. Now, what we would be looking for is for real growth to be above trend. And when you get above trend growth, that means that firms need to increase hiring, and that will improve the labour market. And then that will, in itself, lift consumer spending, and that will obviously have a knock-on effect for demand, and that will improve the real economy further.
Thank you, Mr. Semmens, for your professional insights into these latest announcements. That's all from us on this last trading day. Make sure you tune back in on Monday for all the latest news stories and data releases. Until then, have a great weekend.